Happy Monday, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, July 24th, 2023. So last week, in terms of economic news, we had 5 important releases, economic releases. We had retail sales ex-auto. We had 3 housing measures that came out, and all 5 of those reports were below consensus. So the question is that necessarily bad? I'm going to argue at this point in the cycle, it's probably actually good news. I think we'd rather see some modestly weak but still growing economic indicators that would give the Fed cover for discontinuing their rate increase program, which we're going to hear about and we'll talk more about. But the FOMC, Federal Open Market Committee meeting, meets starting tomorrow, and then Wednesday they'll have a rate decision. So the big question for many investors is how many more increases are we going to see? So in terms of releases from last week, I should start off by talking about corporate earnings a little bit. We're in earnings seasons now, earnings season. We've had 18% of S&P 500 companies report through last Friday. Investors are very focused on corporate earnings, and I would say the 3 things that investors are most focused on at this point, 2 related: inflation, Federal Reserve response to inflation, and corporate earnings. Now, corporate earnings held up a little better than expected during the first quarter. Going into the quarter, the S&P earnings were expected to drop 7%. Ultimately, they came in at a -3. Now, for this quarter, second quarter of 2023, the expectation is they're going to drop about 9%, and that's what we have seen so far after that 18% of S&P 500 companies have released. So it's -9% on a year-over-year basis, and the earnings headwind is really coming from all the cyclical sectors. For instance, energy, the few names that have reported, their earnings per share down 51.3% year-over-year. Materials, same thing, down 33.7%. Also, poor reports from industrials and financials. So that expected year-over-year decline here in the second quarter, for the second quarter of 2023, expectations going forward are lower. So now the S&P earnings valuation is starting to be questioned a little bit because it appears slightly stretched. It is now 19.5 times forward earnings. Just for some context, the 5-year average is 18.6 times. The 10-year average is 17.4. And again, we're at 19.5. I'm not too concerned about that because I do think we can see a rebound in corporate earnings. And what has really happened is revenue has held up well. In fact, it's flat for those 18% of companies I mentioned that have already reported. However, margins have taken a hit, and that's not surprising given the inflationary data that we've seen over the last year. So margins are coming in at 11.1% net margins for S&P companies. If that holds up for the entire quarter, that would be the lowest level since the fourth quarter of 2020. The good news here, if this happens, analysts' expectations are an increase in margins both in the third and the fourth quarter back to the 11.7% level. So if that happens in terms of corporate earnings, if we continue to see revenue at least staying flat, edging up a little bit, and margins rebounding in the second half of this year, that would be constructive for the equity markets. So in terms of the economic data, I already referenced the fact that we had 5 that I deemed to be important last week. We had retail sales and retail sales ex-auto. Both came in at a positive 0.2% month over month, but both were below consensus expectations. Retail sales were expected to come in at a positive 0.5 and ex-auto a positive 0.3. Again, I don't think that's such a big deal at this part in the cycle. Still growth, that's great. We also saw housing information last week, housing starts, building permits, initial claims, all missed expectations. Housing starts missed by about 40,000, building permits by over 30,000, existing home sales missed by almost 90,000. So housing stats for last month were weak for the month of June. However, we'll say we were surprised in the month of May when things seemed to perk up. So I think if you take those 2 months, add them together, the run rate is probably better than it looks as we end the month of June in terms of data. Now, I inadvertently threw in the initial claims. We have not been tracking that often last 2 months. That number started to move, so we have started to look at it. We saw a big increase from the 220,000 a week level up to 260,000 about 3 weeks ago, but it has been coming back down. And for last week, that number was expected to come in at 240,000 new claims. It came in at 228,000. So in terms of inflation expectations, after all that data, again, I believe this is one of the big measurements investors are following very closely. The 10-year break-even rate that we always quote, 10-year Treasury minus 10-year tips, spiked up a little bit last week. It was at 2.28 the week before. It came in at 2.35, 2.35%. And I'm going to argue that is really low. If you think about the expectation for inflation here in the U.S. to only average 2.35% over the next 10 years after what we've seen the prior 18 months, I think we would all take that. So how did the markets react to this news, which looks kind of negative on the surface, but I thought was fairly decent, constructive for the market? And indeed, the equity markets liked it, and kind of neutral for the bond market. So for the week, last week, the S&P 500 was up 70 basis points, 0.7%. The thing that did stick out and that we have been noting is that most of the gains year to date have been taken up by the large cap or the mega cap growth names, the Magnificent Seven, as they're deemed. The old FANG group plus Tesla, NVIDIA, and no Netflix. So those stocks, at one point during the month of June, those stocks were collectively up 55%, and the rest of the 493 other S&P 500 names were flat for the year. So we've been looking for some widening of the breadth, and we did get that last week, I would say. So last week, large cap in the U.S. was up 60 basis points, small cap up 1.2%, and growth, which has definitely led the way year to date in the U.S. markets, that was down 34 basis points. Value, which we love, value up 2.5% last week. So that was good news. International markets down last week, so it lagged the S&P 500, lagging significantly on a year-to-date basis. And the real driver there, again, China, another poor week. China was down 2.7%. On a year-to-date basis, China's down almost 5%, whereas the whole MSCI World ex-US index is up 11.7%. So year-to-date, S&P 500 up 19.24%. Rest of the world up 11.66%. So again, domestic stocks strongly outperforming international. I mentioned fixed income flat for the week. Numbers aren't even worth mentioning. On a year-to-date basis, Bloomberg U.S. Bond Index is up 2.3%. So this week, this is a really busy economic calendar. We've got second quarter GDP numbers coming out, big inflation reports on Friday. But the real big driver this week is going to be, as I mentioned, the Federal Open Market Committee's meeting starting tomorrow and the Federal Reserve's rate announcement on Wednesday. So I'll come back to that. I'll just go in chronological order, hit some of the other things that are happening this week. Consumer confidence, the U.S. index, the Bureau of Labor Statistics reports, that is expected to be up in the month of July, up to 111.5. The month of June, that was up 109.7, so a little bit of increase there. We also saw that in the University of Michigan Consumer Sentiment Index for the month of July, so that would be consistent. On Wednesday, the FOMC I mentioned, but first, new home sales are expected. Given what we saw from those 3 data points in housing last week, expectations come down. So the expectation is new home sales for the month of June are going to drop. They were expected to come in at 763,000 for the month of May. They're now expected to come in at 722,000 for the month of June. So, big one this week on Wednesday, FOMC rate decision. Expectation is they're absolutely increasing rates by 25 basis points. When I say absolute, there's hardly any absolutes in this business, but this is one of them. The Fed funds future now has priced in odds of 25 basis point, and exactly 25 basis points happening is 99.8%. So we're definitely getting that on Wednesday. The question is, do we get more? So I always look at what the expectations are for the end of the year. Rates could put through another increase and then take it off the table by the end of the year. But the expectation at the end of the year, there's now a 64% probability that we'll end the year at a Fed funds rate of 525 to 550. That's where we expect it to be at the end of the day on Wednesday. So 64% chance, that's precisely where we'll be. Another 25% chance that the Federal Reserve will put through at least one more increase, and it will be there at the end of the year. So there are the expectations, and I would have to say, clearly, I think we're getting near the end of even having this discussion, because it's the Federal Reserve is pretty close to finish, I think, with their work. Inflation has been coming down. Again, later this week, we're going to get the PCE numbers, the inflation numbers, and if those come in decently, and CPI has, I think the Federal Reserve can either halt now or maybe they'll do one more, but I think they're near the end of this tightening. So also we're getting the GDP number, the second quarter GDP number on Thursday. The expectation is GDP grew, this is a consensus estimate, 1.6% in the second quarter. Now, you take a look at what's happened in the prior three quarters, pretty strong. So the first half of 2022 was not great. We had two consecutive quarters negative GDP growth, real GDP growth. Third quarter came in at a positive 3.2. Fourth quarter last year, positive 2.6. And the first quarter this year has been revised up to a 2.0 level. Again, the consensus for the second quarter this year is a positive 1.6%. However, the Atlanta Federal Reserve, which we often quote, Atlanta Federal Reserve actually thinks we're going to come in stronger than that at positive 2.4%. That they increased their estimate another 10 basis points last week. I will say the Atlanta Federal Reserve, sometimes I'm skeptical. Their numbers generally seem to be out there, but over the last year, they have been much closer to the real number than the consensus estimates have been. So Friday of this week, we're going to get four more big indicators. Personal income for June, that is expected to be up a little better than May. May was up 0.4% month over month. Personal income is expected to rise 0.5% for the month of June, a little better than the prior month. Personal spending also expected to improve. Personal spending in May was up 0.1% month over month. The expectation that's going to come in at a positive 0.3%. Now, the big one for Friday, I think the big one, personal consumption expenditure, PCE, Fed's preferred measure of inflation. That will be very closely watched. The month of May, that was up 0.1%. Expectations is going to be up 0.2% for the month of June. PCE core, X housing, food, X energy and food. That is expected to come in at a positive 0.2%, was actually down from May, which is up 0.3%. So that's it. I know there's a lot there. Thank you for sticking with us. We really appreciate you watching this program. We'll be back next week and look forward to seeing you then. Thank you.